Welcome to the deep dive. You know that feeling, right? When you find something genuinely high quality, maybe something you've really been looking for, but there's this unexpected on sale sign. Not just a discount, but like real solid value. Well, today that's pretty much what we're doing, but we're applying it to your portfolio. We're going deep on what some market watchers are calling stocks on sale right now. These are companies that seem undervalued currently, but they might be bursting with some serious growth potential down the line. This isn't just bargain hunting, really. It's more about trying to strategically spot future leaders, maybe, at today's prices.
It is a fascinating landscape, definitely. We've certainly seen market movements, both over the past couple of years and even more recently, create these unique pockets of opportunity. While some stocks and sectors have, well, soared, others, even with strong fundamentals underneath, have seen their share prices kind of lag. And that creates this whole on sale idea. It's not about chasing hype. It's about recognizing that underlying value and the future prospects. We've pulled together some really interesting insights from recent analyst reports and valuation metrics that seem to point toward these specific companies. Okay, now, just a really quick but absolutely essential point here. Everything we're discussing today in this deep dive, it's purely for informational purposes. Think of it as an exploration of what the data and the market analysis might be suggesting. It is definitely not financial advice.
Absolutely. And hey, if you find this kind of deep dive interesting, if it helps you stay informed, please do remember to like and subscribe. It helps us keep bringing you this content. So for you, our curious listener, what does all this actually mean? We're going to try and unpack why some really big players and maybe even some names that are flying a bit under the radar might be worth a closer look right now, especially when you stack up their current valuations against their long-term potential. So when we talk about stocks being on sale, that idea of a discount, what are we really looking for? It's got to be more than just a hunch, right? There must be some specific characteristics, some kind of method here.
Oh, absolutely. Think of it almost like a checklist, based on what the analyses tend to highlight again and again. First off, we're looking for a low valuation. That's key. And this often shows up in metrics like the trailing price to earnings ratio, the PE, being surprisingly low. For instance, when you see a PE under 10, that's a pretty big flag. It suggests the market might be overlooking the company's financial strength or maybe its turnaround story. For a company aiming for growth, that's almost unheard of, Usually you see that in really mature, slow-moving industries.
Okay, so it's about seeing value where maybe the wider market isn't quite focused. That's where it gets really interesting for me.
Exactly. Then the second crucial thing is significant growth or turnaround potential. These aren't just, companies sitting still. They're often positioned in these big growing areas. Think AI, cutting-edge biotech, essential infrastructure, or maybe the company's going through major restructuring that could unlock a lot of value. Third, and this is often the exciting part, we look for actual catalysts on the horizon. These are specific things you can point to that might trigger a reevaluation of the stock. Could be anything, a big share buyback like we're seeing with Uber, perhaps that signals confidence and cash flow, or maybe crucial trial results for a biotech like Novavax, or even broader sector re-ratings where a whole industry gets looked at differently, or, macro trends like the big push for renewables helping a utility like AES. These catalysts are kind of the spark.
Right, the thing that gets the market to pay attention again. This raises a key point, though. We're talking value, not just a low price tag. So beyond that basic PE ratio you mentioned, what other metrics really count? How do we dig a bit deeper?
Yeah, metrics are definitely our guide here. Beyond that trailing PE, we often look at the forward PE. That one focuses on expected future earnings, not just past performance. And that's really important for growth companies because it gives you a peek at how the market might value them as they actually grow. And then there's the PEG ratio. That's the PE divided by the expected earnings growth rate. Generally, a PEG ratio below 1 is seen as attractive. Why? Because it suggests you're paying less for each unit of expected growth. It's a pretty powerful filter, actually. It helps show if that future growth is kind of on discount right now.
Okay. So it's not just the current price, but what you're paying relative to the future potential. That's a really different lens. What else should we be thinking about?
Exactly. It totally shifts the perspective. Another really vital thing is sector context. PE norms and really all valuation metrics, they vary wildly between industries. A utility company's PE is just naturally going to look very different from a high-flying tech or biotech company's PE. So comparisons really need to be made within the same industry to make sense. Then there's timing and catalysts, like we touched on. Some of these undervalued stocks, they just need time. Time for those trial results or regulatory nods or for the market sentiment to shift. So patience can be, well, pretty important here. And finally, never forget portfolio balance. Even stocks that look undervalued still carry risk, right? So diversification is always key for managing your overall strategy.
Okay, that framework makes a lot of sense. Let's pivot now to some actual company names that are getting attention in this undervalued space. Maybe start with some of the tech giants we probably all know, and then we can branch out. First up, Alphabet.
Right. Alphabet. DOOGL. It presents a really interesting case right now. Recent analysis suggests it's trading at valuations quite a bit below its 5-year averages. In fact, some reports are even calling it arguably the cheapest of the Mag 7 stocks. And for anyone wondering, Mag 7 is just that group of the 7 biggest tech companies driving a lot of the recent market gains. So why Alphabet? Well, it's got massive, steady cash generation, huge tailwinds from AI, obviously, and just incredible scale. That offers really attractive long-term potential, even at what analysts see as these currently lower prices. The insight isn't just that they do AI, it's their data advantage, their ecosystem. It makes their AI position really hard to challenge, potentially locking in future leadership despite the current valuation.
That's a strong mix for such a huge company. But, some might ask, if it's that strong, why isn't the price higher already? What about Qualcomm? We know they're big in mobile, but how do they fit this undervalued idea?
That's a great question, and it often gets to the heart of why something is undervalued. For Qualcomm, ticker QCOM, its stock performance has been a bit muted this year compared to some others in the space. But it's still an absolutely vital sort of foundational player in both the AI boom and mobile tech. What really stands out is its strong free cash flow, that's the cash left over after running the business and investing, and its huge market cap, around $200 billion now. Its valuation looks pretty attractive when you consider its long-term growth prospects, especially as it makes these strategic moves into higher growth, higher margin areas. Think cloud, specialized AI chips, 5G for businesses, and more services. It's like a core piece of the tech puzzle that maybe people are overlooking because its business is evolving.
And speaking of core pieces, you really can't talk global tech without bringing up Taiwan Semiconductor Manufacturing Company, TSM. How does this absolute giant measure up as potentially undervalued, given how critical it is?
TSM is a fascinating example here. It is the world's largest dedicated contract chipmaker. I mean, over 60% market share last year. Dominant. Yet it's trading somewhere in the $150 to $160 range, which, according to analysis like Morningstar's discounted cash flow or DCF model, suggests it's at a noticeable discount to what they estimate its fair value is. And just quickly, DCF is basically a way to estimate a company's true worth by projecting its future cash earnings and then figuring out what those future earnings are worth today.
Wow, a significant discount on such a crucial leader. That does sound pretty compelling. What's behind that undervaluation and what's the growth narrative?
Well, the stock hasn't quite bounced back fully from a broader tech sell-off we saw earlier in 2024, one that hit some AI-related names particularly hard. So that's created what many analysts see as a buying opportunity. Its PE ratio is still relatively low compared to other semiconductor peers, which often trade at much higher multiples, even with all this AI-driven demand. Now, growth potential. TSM is incredibly well-positioned, seeing long-term demand from AI, the Internet of Things, connected devices everywhere, and high-performance computing. This is fueled by semiconductor firms consolidating and just the relentless need for more advanced chips, those tiny, powerful components. Analysts see steady, strong revenue growth ahead because of its dominance and its partnerships with huge players like Apple and Nvidia. Can't make iPhones or top AI chips without TSM, basically. Plus, you have this global push for more local chip production, like the USC Chip Piece Act, giving it extra momentum. Of course, you always have to mention the risks. The semiconductor industry is cyclical, goes up and down, and there are ongoing geopolitical tensions around Taiwan that investors watch closely.
Okay, so we've hit some massive tech names, but it's clearly not just about big tech, is it? Seems like there are interesting opportunities popping up across different sectors, showing that value can really show up anywhere. Where else are analysts spotting potential?
You're absolutely right. Diversification is always smart. Beyond tech, look at Johnson & Johnson, J&J. This is a healthcare giant, a real bedrock company currently trading at what look like attractive valuations. Analysts, including folks at Barron's, have pointed out its strong dividend yield, that regular cash payment to shareholders. Especially notable since the healthcare sector overall has been valued at multi-decade lows recently. Its forward PE is hovering around 16 times. Compare that to tech over 30 times, or even the S&P 500 average around 22 times. It looks, well, relatively cheap. The insight here might be that, okay, maybe it's not explosive growth like a startup, but J&J offers consistent profits, essential products, making it a potentially stable, undervalued play in a sector that's always needed.
Yeah, that sounds like a potentially solid, maybe more defensive choice. But what about something a bit more dynamic? A company known for disruption, but one that analysts also see as on sale. What about Uber?
Uber, Uber, yeah, that's an interesting one. It is fundamentally a growth stock, no doubt. But you're hearing more from both management and analysts that it might be undervalued right now. What's really compelling is they're actively doing this $1.5 billion accelerated share buyback. That's not trivial. It's a strong signal that management feels very confident about future free cash flow and profitability. And analysts seem to agree, projecting significant scaling still ahead, even with all the competition in ride sharing and delivery. So the takeaway could be that Uber's maybe moved past its hyper-growth, money-losing phase. It's proving it can be profitable and generate cash, but the market might still be pricing it based on its past, not its current financial strength.
That makes a lot of sense. A growth story may be turning into more of a profitable value story. Okay, and for something maybe a bit more under the radar, but still in that enterprise tech space.
Datadog, DDOG, is a good example there. Bank of America highlighted it as a potentially underappreciated AI play. It's a decent-sized company, around a $42 billion market cap, and they provide these crucial monitoring and analytics platforms for cloud applications. Analysts see significant long-term upside, mainly because of its deep connection to cloud-native tech and AI-related enterprise monitoring. These tend to be sticky, recurring revenue models. As companies rely more and more on complex cloud setups and AI, Datadog services become almost essential, right? Creating this powerful, ongoing revenue stream. Some analysts are forecasting upside potential to around $138 per share from where it is now, suggesting quite a bit of room to grow.
Okay, we've hit giants, disruptors. Any other interesting names worth a quick mention just to round out this undervalued picture?
Oh, definitely. The market always throws up possibilities. You've got large cap tech veterans like Intel, INTC, and Cisco, CSUO. Various value screens pick them up as trading at low PE multiples compared to their history or peers. And they're both working on shifting their businesses towards higher margin services in cloud, AI, 5G. If those shifts pay off, there could be value unlocked. Stepping outside tech entirely, there's Zim Integrated Shipping, ZINIM, Maritime Logistics. It has an incredibly low trailing PE, something like 0.8 times. Makes it highly speculative for sure, but potentially a big recovery play if global trade and shipping rates bounce back strongly. Then there's AES Corp, AES. That's a utility company trading at a low trailing PE around 5.6 times. It seems uniquely positioned to benefit from those massive long-term trends in renewable energy and upgrading the power grid. And one more. Novavax, NVAX, healthcare biotech, trading around 2.5 times trailing earnings. It's definitely more speculative, heavily dependent on its pipeline and getting approvals, but some see it as deeply undervalued with potentially huge upside if things go right clinically and commercially.
Wow, okay. So what does this all really tell us? We've journeyed through a really diverse set of companies here, from the biggest tech players harnessing AI to stable healthcare giants, critical infrastructure, even shipping and utilities. And all of them flagged by analysis as potentially undervalued right now. It really hammers home that opportunity isn't just in one corner of the market. Value can pop up in some surprising places.
And if you sort of connect that to the bigger picture, what's really fascinating, I think, is that many of these companies, even though they're on sale now, are fundamentally plugged into sectors with really strong, undeniable long-term tailwinds, whether it's the ongoing, explosion of AI or the global push for renewable energy and sustainable infrastructure, or just a constant need for essential global services. These are powerful foundational shifts. Understanding those underlying megatrends helps us look past the short-term market noise, maybe, helps us see the future potential in these undervalued spots as their specific catalysts play out, and the market eventually perhaps recognizes their true value.
It really does show that even when markets feel dynamic, maybe even a bit chaotic, real opportunity is often there. You just need to know where to look, what metrics matter, and maybe what questions to ask. So as you go about your day, maybe think about this. What other areas, what other industries might be quietly building up their own hidden value, just sort of waiting for their own deep dive to bring it to light?